If you want to buy your next house before you sell your current house, then this video is for you. So I have a lot of clients for some reason right now that they want to move to a new house. Maybe they're upsizing or maybe they're downsizing, but they don't want to go through the hassle of having to put their house on the market, time the purchase of the new house to where they close on the same day, and be rushed to get all the furniture out of the house and get the moving vans in place and all that stuff. If you are like them, what you would really like to do is be able to take your time, be able to buy your next house and close on it so you can move all of your stuff to the new house in a leisurely fashion. But the question is, how do you do that? Because obviously, most people need some of the funds from their current house, from that equity, to be able to buy their next house. So here's what I'm having a lot of my clients do. This is very important, before you list your current house, you want to get a home equity line of credit. Now, you can get a home equity line of credit. I actually have some lenders that will go up to 100% of the value of your house, but you can typically go up to at least 90% of the value of your current house. So let's just say, for example, hypothetical math, that you have a $400,000 house. It's worth $400,000 right now. Let's say you only have a $100,000 mortgage on it. Well, you could go up to a $360,000 loan amount, right? You can go up to 90% of the value of your house. So what you would do is you'd be able to get a home equity line of credit for $260,000. Now that's your money. You don't have to season the money. I get that question a lot of times. It's already seasoned because you own the house. Now what you would do is you would be able to get qualified for a mortgage on the new house for whatever you wanted that end mortgage to be. Let's just say, for example, you're buying just for easy math, let's just say you're buying another $400,000 house, and you want your end mortgage on that house to also be $100,000. Well, in this example, I would get you a $100,000 mortgage on the new house. We would take the home equity line of credit that you had gotten off of your old house, and that'd be your down payment. You would put $260,000 down from the home equity line of credit. So now you close and you have two houses. So now you can put your old house on the market. As soon as that house closes, you're going to pay off the home equity line of credit that you got on it, along with the first mortgage that you already had. And now you have your new house with the $100,000 mortgage that you wanted in the first place. Of course, you can use that money however you want. If you want to have a $300,000 mortgage, so you'll have more cash left over after closing from the old house, of course, that's fine too. Now, the trick with this is you have to qualify for both mortgages at the same time. So what we want to make sure is that you don't get too large of a home equity line of credit and still qualify. Now, the good thing about that is the home equity line of credit you get, you're going to qualify off of typically the interest-only payment on whatever that draw amount is. So I have several clients right now. I have him getting a home equity line of credit. We have made sure that it is not too large, so he still qualifies, and everything works out great. Now, of course, the next question is, how do you qualify? That's really a topic for another video, but I am going to talk about one particular segment of the population I'm seeing a lot of this with, and those are people that are retired. So you're already retired, and let's say that you have a 401k or some sort of retirement account, IRA. You can qualify off of the distribution from your IRA or your 401k. And all you have to have is a one-time distribution. So a lot of people get a little freaked out. They're like, well, I don't want to take a $5,000 distribution from my 401k. You don't have to. You just have to do it once. The easy math on this is that you have to show 3 years of continuance. So you would take whatever your 401k balance is, divide it by 36, that's 36 months, and whatever that is the maximum monthly income that you could use to qualify on a mortgage. So I guess what I'm saying is there's a lot of different ways to orchestrate this move to make sure that you qualify. So it's important that you work with a mortgage broker, like myself, of course, that can help you navigate through all this and make sure that you don't get under contract on a house and then find out from some person or lender that doesn't know what they're doing that you don't qualify and you blow the whole thing up. It's important to do what I call mortgage planning. So if this is something that you feel suits your particular need, please reach out to me. You can go to my website, mortgagesbyscott.com. If you have any questions about this, just put it in the comments below and I'll make sure and respond. And if you found this video helpful, it would be super helpful for me if you would hit like and subscribe, and even more helpful if you would share this, on YouTube or Facebook or wherever, Instagram. So anyway, thanks. Talk to you soon.